Hello all, today we are going to discuss treatment of retained earning and accumulated losses at the time of admission, death and retirement. All the treatment will be same in all the three conditions, right? So first take the accumulated loss. So accumulated loss, most of the time they will appear with the name of profit and loss with the debit balance or advertisement suspense account. You will see that in your balance sheet right here. Profit and loss account appear and profit advertisement suspense account will appear, right? So we have two treatment. Most of the time 99.99% you will have this one, right? Distribute or settle loss and the one is carry forward to new balance sheet, right? Now what is that? If that loss is appearing in the balance sheet at the time of revaluation of admission of a partner or death or retirement, what happens? Whatever the loss is there, most of the time that is settled through the current account or the capital account, as the case may be, as they are preparing their capital account. So they will be settled through the capital account of the partner or the current account of the partner, right? So because being a loss, so their capital account will be reduced. So old partners capital account in old PSR, in old profit sharing ratio, to profit and loss account and to advertisement suspense account, right? So this would be the entry, and this impact of this entry would be profit and loss or the advertisement suspense account, whichever is there, because we have credited it, that which are shown in the asset side, they will be disappear from the new balance sheet. So they will not appear in the new balance sheet, and old partners capital account will be reduced. In the second condition, sometime what happens, the partner agree to that whatever the loss, accumulated loss is there, minimum chances are there in the case, in your question, they want to carry forward the loss as well, but along with the accumulated profit or something like that, right? So if to make the question complicated, if they say whatever the loss, accumulated losses are there, carry forward that to the new balance sheet as well, so you have to take the adjustment entry as we take the adjustment entry in the retained earnings. So what is that? In that condition, the adjustment entry would be reversed, that is sacrificing partners capital account debit to gaining partners capital account, right, in sacrificing ratio, right? So this would be the entry, because why we are taking the sacrificing partners capital is reduced. So the partner who is existing partner or the old partner, he must be sacrificing or giving some of the shares to the new partner, and he is sacrificing his share, and because his share is in profit and losses, right, these are the losses and he has to bear, and he's saying okay, the new partner will bear my share of loss. So what he has to do is, to bear that loss in future, he has to give something currently. So that is why the sacrificing partner who is giving his share to the new partner, his account will be debited, and the gaining partner who is going to bear that loss in the future, that is why his account is being credited over here. So this is the reason that this adjustment entity is always gaining partner to sacrificing will be reversed in case of accumulated losses, right? Which is very easy. One by one we will take. general reserve. Let's say you have general reserve or you have profit and loss credit balance, right? If you have either of one or both of them. So in that condition, there are two situations. Again, if the partner don't want to carry forward, so I'm writing not to carry forward. That means they want to distribute it, or the question is silent, then we will take this one, right? If need to carry forward, that means whatever the balance is there in the old balance sheet, the partner decided that this amount will be taken to the new balance sheet as it is. So what would be the treatment then? So first is not to carry forward. In that condition, the amount which is there, general reserve or the profit and loss, this is a credit balance and given to the partners, so their capital account will increase, so partners capital account will be credited, and general reserve or profit and loss account balance, surplus in profit and loss account, will be debited to old partners capital account. I'm again taking capital account or current account as the case may be, capital account in old PSR, in old profit sharing ratio. This entry will be in old profit sharing ratio. So this would be the entry, right? So general reserve or any kind of reserve or profit and loss account debit to old partners capital account to old partners capital account in the old PSR, in old profit sharing ratio. If they don't want to distribute the general reserve of profit, they want to keep it forward, then obviously we have to take the adjustment entry. Then again the adjustment entry would be same, gaining partners capital account debit to sacrificing partners capital account. So this would be the adjustment entry, and that for that matter you have to find out the gaining ratio and the sacrificing ratio, because that can be changed. It may be possible that all the partners are not involved in that, right? It might be possible that only one partner is sacrificing the all profit sharing ratio to the new partner, so only one old partner will be there in that condition, right? So you have to find out the sacrificing ratio in this condition in adjustment entry, right? So this is your general reserve on the profit and loss, right? Then comes the second most important and very popular one, that is workman compensation reserve. Workman compensation reserve. Now what is the treatment of this? Workman compensation, let me tell you what is workman compensation reserve is. First thing, out of profit of the organization, that is partnership, some of the amount is transferred to the workman compensation reserve, so that if in any condition, if any of the employee gets injured or any case happen like this and they file the case against the organization or the partnership for the compensation, so that amount of compensation will be paid through this account. That is why it is called workman compensation reserve, right? So this is prepared from the earnings which is being done by the organization or the partnership firm, right? So we have treatment according to the compensation. Let's say there is no claim against workman compensation reserve, right? We don't have any claim against workman compensation at all. So what will we do with the workman compensation reserve? So all the workman compensation reserve will be distributed among the all partners. So Workmen compensation reserve account debit to all partners. Capital or current account, I'm writing capital account as the case may capital account, right, in all profit sharing ratio. This will be distributed in the all profit sharing ratio. This is one case, right? In second of the case, if claim exists but less than reserve, right? So I'm giving the example here so that you can understand. In that condition, let's say Workmen compensation reserve is 1 lakh rupees and you have two partners, X and Y. Okay, X and Y, we have two partners and 1:1 is the ratio, and the claim against it, let's say claim against it is 20,000. So this is less than Workmen compensation reserve. So this is claim. You have to create the liability. So how do we create that? With the help of the Workmen compensation reserve, you will debit it Workmen compensation reserve account debit with the whole amount. Let's say in this condition 1 lakh rupees, the example which I have given. To first you will create the liability. So claim against Workmen compensation reserve account, right? Here the claim is 20,000, so I'm writing 20,000, right? It is only the example I have given, so I'm taking it. Don't think that this is universal amount. And rest of the amount, which is 80,000, will be distributed to the old partners. So old partners capital account in old profit sharing ratio, right? So in that condition it is 80,000. So here A and B, A is capital account, B is capital account, they will get 40,000 because they are equal partners, so they will get 80,000, right? This is second case. Let's see if claim exists. But equal to WCR. Let's say in this condition we have Workmen compensation reserve 1 lakh rupees, same, and the claim is also 1 lakh rupees. So no issue, we have enough amount of Workmen compensation reserve. So the entry would be Workmen compensation reserve account debit. Here the example is 1 lakh rupees. I am writing 1 lakh rupees to claim against Workmen compensation reserve account, right? 1 lakh rupees. So whole of the amount has been used for creating the liability claim against Workmen compensation reserve till the time that amount is settled by the court in favor of employee, that the organization has to pay that amount. This will be shown as liability, right? So that will be shown in the liability side of the balance sheet, right? And the third thing is, I have to raise it, D case. In that condition we have some complication. And how do we do that, right? How do we solve that? Let's see. Here D case, if claim exists and more than WCR, you have WCR here. Let's say in this example WCR, we have 1 lakh rupees and partners are X and Y, 1:1, right? So partner are X and Y, 1:1 is the ratio. workman compensation is 1 lakh rupees, but you have claim, let's say 1,50,000 rupees. So you have claim more than your workman compensation reserve. So how do we do that? How do we take the entry? Okay, 1 lakh rupees, simple, we will transfer to the claim account. So workman compensation reserve account, that will be transferred, 1 lakh rupees will be transferred to claim account, right? And we have to make the claim against workman compensation reserve, right? And that is 1,50,000. Now we need 50,000 more rupees. Now in that condition, what happens? At the time of this whole process, we prepare the revaluation account, and everything we need, we take it through revaluation account. So balance amount will be taken through revaluation account. So revaluation account will be debited here. Revaluation account debit by 50,000. Now that's it. The entry is created, right? So workman compensation was 1 lakh, claim was 1,50,000. So we have taken 1 lakh from the reserve, 50,000 from revaluation account, and 1,50,000. Now we have a loss of 50,000, right? This is if we are preparing the revaluation account, so we will have a loss because we have a provision for 50,000 here, and this loss has to be set off against the capital account of the partner, let's say X and Y. Here we have taken 1, so 25,000 X will give, 25,000 Y will give. So whatever the debit balance is there in the revaluation account, that will be settled through the capital account of the partner or the current account, as the case may be. So here I am taking capital account. So partner's capital account will be debited against any kind of loss. So I am taking the old partners here, old partners capital account debit, right, in old PSR. Here we have taken 50,000 rupees to now revaluation account, because this is a nominal account, will be credited, and that will be written off from the books of account. So this will be the second entry. If your claim against workman compensation reserve goes beyond the amount which you have created in the reserve. So this is the treatment, right? So you have 4 cases in case of workman compensation reserve, right? Then we have another, and whenever you are creating the liability, right, that liability will be shown in your liability side of the balance sheet till the time it is being paid to the employee as per the instruction of the court, or if the company agrees to that, then the company straight away pay to that. Oh, partnership, here we are discussing the partnership, right? So the third thing is you have investment fluctuation reserve, investment fluctuation fund, rather investment fluctuation fund. Now what is investment fluctuation fund? Investment fluctuation fund is created by the partnership for fluctuation in the value of any kind of investment. If the investment value goes down, the market value of the investment goes down from the purchase value, so whatever loss happens, that will be set off against this investment fluctuation fund. So any fluctuation in the investment will be taken care by the investment fluctuation fund account, right? So simple, we have the first case, if no information info of market value is given. Now we have to take now the certain things. Let's say in the balance sheet we have investment. This is for all example, we will take 1 lakh rupees, right? And we have IFR, let's say for 20,000 rupees. Investment fluctuation fund, here we have taken fund, so we will take this fund. Investment fluctuation fund is 20,000. So there is no information regarding the market value is given. That means the investment value, what is the, this is purchase value, because all the assets are shown on the purchase value. So no information is given what is the market value. So what we will take, what will we assume that the investment value is static, that is 1 lakh rupees. So whatever the investment fluctuation fund is there in the balance sheet, that will be distributed among the partners, old partners in old profit sharing ratio, right? So investment fluctuation fund account debit, here I am taking as 1 lakh rupees to old partners capital account or current account, right, in old PSR. Simple, that will be distributed to the partner, right? Second, if market value is same as purchase value, market value is same as purchase value, so same entry as case A. So whatever entry we have taken over here, same entry will be taken. IFF account debit 1 lakh rupees to old partners capital account in old profit sharing ratio if the market value is same, right? Let's say it says market value is 1 lakh rupees, that additional information is given. In C case, if market value is above purchase value, it can happen, the market condition can be taken the value over the purchase value. Let's say additional information is given, additional info, investment value as 1,50,000, so no need to use IFF. So same entry as case A. So again we will distribute the 20,000 rupees because this is going beyond above, so this is profit for the organization, so no need to use 20,000 rupees. But now D case, if market value is less than purchase value, now we have to take the example. Now let's say this market value is 50,000 rupees. Now sorry, we have to take equal, market value is 20,000, let's say 90,000. So if the 90,000 is there, that means the investment has gone down from 1 lakh to 90,000, 10,000 loss. So 10,000 will be settled from the investment fluctuation fund. So what will be the entry? So entry would be, we are going to utilize the investment fluctuation fund. So investment fluctuation fund account debit, right? So I'm taking the 10,000 rupees right now, and to investment account, because we have to make the investment at 90,000 rupees. So investment account will be credited by 10,000 rupees because we have to bring down the investment 90,000. In the new balance sheet, the investment will come with 90,000 rupees. And what about the 10,000 rupees which are remaining? That will be distributed to the partners. So investment fluctuation fund account debit, after taking this entry, adjustment entry, we will distribute to old partners capital or current account in old profit sharing ratio, right? In this condition we have 10,000 rupees balance, so 10,000 rupees will be given to the old partner in old profit sharing ratio. We have taken X and Y in equal ratio, so 5,000 to X and Y. So if the equal partners are there, okay? So this is the case when the purchase value is less than, but the amount of loss is less than IFF. Now in next condition, let's say the market value is 80,000, right? So E case, if market value of investment is 80,000 rupees. Now what to do? Now what are we going to do that? In that condition, right? So we have enough amount to adjust. So first thing, we will take the IFF, investment fluctuation fund account, debit 20,000 rupees. 2, we will take the investment account to downward, that is investment account, we will take 20,000 rupees. Now your investment will appear with 80,000 in the new balance sheet, right? And the whole of the investment fluctuation fund amount has been used to decrease the investment value, and investment value is now 80,000, which will appear in the new balance sheet, and there is nothing left for the partner to be distributed, so nothing will be given to the partners. Now in next case, if market value of investment is 50,000, now what will you do? You have only 50,000 rupees and your investment value remains only 50,000 rupees, and you have IFF only 20,000 rupees. What will you do? Okay, we have revaluation account with us. So first thing, we will use investment fluctuation fund account, and we have a balance of 20,000 rupees here. And 2, we will decrease the investment by how much? The amount by which the investment has gone down. So 1 lakh rupees purchase value, market value 50,000, so investment has gone down by 50,000. So we have to take the investment by 50,000 credit. So investment will appear in the new balance sheet with the new amount, that is 20,000 rupees. Now we have a balance of 30,000 rupees because we have got only 20,000 rupees from here. So we have 30,000 still loss. So that loss will be compensated through revaluation account. Any revaluation of asset or reassessment of liability will be done through the revaluation account in case of admission, death or retirement, right? So revaluation account debit, and the balance amount is 30,000. This is it. Now till the time we are having the balance, we are distributing to the partner. Now we have a loss, so obviously the partner will compensate that loss through their capital or current account. So this revaluation, being a nominal account, will be credited here so that it is written up from the books of accounts. So 50,000, 30,000, the amount we have taken from revaluation account, 30,000, and that 30,000 will be brought in by the old partner's capital account or current account, as the case may be, in old profit sharing ratio, right? This is also in the old profit sharing ratio, not in the new ratio or sacrificing. So this is it, right? If you have investment value which is gone beyond less than the IFF which is available in the balance sheet, so what you have to do is, whatever amount is available in your balance sheet, you have to use it to reduce your investment account, and rest of the amount which is required to take the investment to the market value, that will be taken from the revaluation account, and that balance will be written up from the capital of the current account of the partners in their old profit sharing ratio, right? So this is how we have the treatment of accumulated loss and the retained earning. These are the most appeared your retained earnings in the books, and anything can come with the other name, but mostly you have these 3 things. The first thing is general and profit and loss, and the second thing is workman compensation fund and the investment fluctuation fund. If anything comes, you have to use these fundamentals, right? So this is it for the retained earning, the accumulated losses, and now you are good to go for the treatment whatever are there at the time of admission, death and retirement also. So thank you very much.